Hi everyone. Hope you are doing well. Was having some discussions in WhatsApp group as well and was enjoying it. Need to discuss further things for today as well. If you've got any questions or queries from the last session, you can confirm here. Aisha, haven't you joined the group yet? Hi, afternoon, Sabina. Sure, Reena. Okay, let me share here. I'm not sure why haven't you people joined the group yet. We have been having good discussions over there since last night. Let me share the link here. Let me know if you have got any questions from the last day. Yes, Amna, fine with that, fine with that. Komal, can you please let me know if you could access the group link I have shared as response to Reena's question, and I've sent it to everyone. Let me know if you could access the link. Sure, Komal. Check it. Okay, the link isn't working. Fair. So you can observe there is a WhatsApp number on the first page of PPT. There we go. Drop me a message over there. I'll be sharing link with you in private message on WhatsApp. Okay, Reena, I'm not sure why isn't that working. Kindly drop me a message on WhatsApp. I'll be sharing the link from WhatsApp to your private number. Amna, we have been discussing that the change from cost model to revaluation model, if judged logically, that will affect the measurement basis of a property, and any change that affects the measurement basis, that affects the presentation, and that affects the classification of any item is treated as change in accounting policy. But change from cost model to revaluation model is not treated as change in accounting policy because this is an exception. Since IAS 8 is very different from case to case, is varying its assumptions from case to case. That's why there is an exposure draft pending on IAS 8 that wants to change the requirement of IAS 8. So I'm telling you very categorically that change from cost model to revaluation model, if we are judging it conceptually, that is a change in accounting. That is change in accounting policy, but IAS 8 specifically exempts this. But chalo, I haven't yet started working somewhere. I'm just answering the questions. Hassan, do you have this PowerPoint? You can find it in the handout section. True, Zayan. That is part of industry practice as well, and also required by IAS 8. Same is the discussion going between FIFO to EBCO and EBCO to FIFO. And that is the main reason why IAS 8 is expected to change in near future. And that is the current issue of SBR. Amna, this is specifically exempted for IAS 16 only, not for IAS 38 or IAS 40. That is not applicable to IAS 38 and IAS 40, only IAS 16 because of its impracticality. Right, that's right, Zayan. So I have received your messages. So I'm switching the screen now. Adris, yes, sure. No, Pooja, this is old exemption. From cost model to revaluation model is exemption already present in IAS 8. The second exemption that I'm talking about from FIFO to EBCO is something proposed. That would be after that exposure draft has been issued. Yes, I'm not true. In IAS 38 and IAS 40, there is a change in accounting policy. Okay, let's start discussing. Few of you students answered me, sent their answers to me, and for few I could. Ola, we'll try level best because I'll be trying to focus on some conceptual gaps because I can observe that you students are lacking very badly in some concepts. Since the performance measures are contingent, we cannot be sure that the examiner will examine this. So let's see how could we divide our time. I'll try my best to come over the performance measures as well. Okay, see here. Let's start discussing the Marine Limited. The question reads, what I've told you in last session, please be very clear on this. Paper SBR will not earn you marks merely for conclusions. Paper SBR will reward you marks for the discussions. What I observe personally, that while students try to answer, they are very keen, they are very excited to conclude something. If the examiner asks something whose treatment the student already knows, the student believes I can get 100% marks by answering the question, but your conclusion is not that important. It is though, but it is not that important. What's more important is your discussion. So I structured a question that Marine Limited raised funds for business operations by issuing 60,000 8% convertible bonds. When you have observed that these bonds are convertible, you might feel that I have caught what the examiner is going to ask. You know well that we have to apply split accounting for convertible bonds. This is what we have been doing so long. But what's important here in this question, I told bonds are redeemable at 9.282% premium to par. This is what we calculated yesterday as well. On 30th September 2022, if we count the maturity period, it's from 2018 to 2022. 19, 20, 21, 22, 4 years to mature, or convertible into $1 ordinary shares of Marine Limited by a variable number of shares equivalent to redemption value. Remember, here the number of shares that the bondholder is expected to get are not fixed. I have kept the number of shares variable. Shareholder, the bondholder, will in either case be getting the same amount. Even if the bondholder chooses to get it redeemed for cash, I'll be giving them the same cash. If the bondholder goes for the shares conversion, will still be getting the value, same value shares, because the number of shares will vary depending on the share price at the date of redemption. Now this is where your answer must change. This is where your answer must change. You'll have to discuss not the difference between simple bonds and convertible bonds, but you'll have to discuss the convertible bonds with fixed number of shares and convertible bonds with the variable number of shares. This is where the question's discussion lies. Getting my point? You are not supposed to discuss simple bonds with redemption option only versus convertible bonds. Here the discussion is not going that way. The discussion is going somewhere else. The company having issued convertible bonds that are convertible into fixed number of ordinary shares will be dealt differently, and having issued number of bonds, convertible bonds with variable number of shares will be dealt differently. Getting? So in this question, the number of shares are variable. Effective interest is 10%. I would like to start a bit of discussion for 10 minutes, 5 to 10 minutes, I believe. Please hear my question well. What is difference between coupon rate and effective rate? What is difference and why is there difference between coupon rate and effective interest rate? Anyone waiting for your answers? Good. Ola says because of transaction cost. Ananya saying that this is the market interest rate. Sorry, this is not correct. Good, Aisha, that is fine. And why the effective interest rate is different from coupon? No, Sally, that's not correct. Pooja, very close. Rachel, not satisfying. Mix. No, Rachel, not yet. Sarmad. Good, Sarmad, good. That is because of the premium on the principal. Fair. Rohan, Matthews, you are correct. But why is effective interest different from coupon? Jayal, that's fine. Daniel, you're correct. This is applied on something. Fair. Why is effective interest different from coupon? No, no, Zayan, that is not in real terms. No, Pooja. Effective, if you start charging effective interest, your annual interest will be different every year. Let me clear this. Please follow me. Sabina, that makes sense. Uh, let's discuss some areas where the opening balance of financial asset or liability fair, the opening balance of any financial asset or liability is different from okay, is this possible that the opening balance at which I am recording an asset, financial asset today, or a financial liability today will be different from its redemption value? Number one, we have read earlier, you must have read earlier that there is a type of bonds that are simple bonds. Simple bonds. What's special about simple bonds? There is nothing special. It's very simple. Simple bonds are issued and redeemed at par. Easy? What are simple bonds? Simple bonds are issued and redeemed at par. So if I get $1 million today, after 4 years, after 5 years, I'll be giving back $1 million to the debt holders. Easy is that? No, Rachel, I haven't cleared that. I'm creating the background now. I'm creating the background now. I'll be answering by the end of my this discussion, 15 to 20 minutes. Why is effective interest different from coupon? Nice, Rina. Uh, my simple question. Can the brought down balance of simple bonds be different from its redemption value? Repeating, can brought down balance of simple bonds be different from its redemption value? Hafiz Hanan says no. Sabina says yes. No. Avinash, no. No, Ola. Can be, okay. Hamza, you're saying it's usually different. Amina, remember, I'm talking about simple bonds. I'm talking about simple bonds whose issue value and redemption value is supposed to be same. Issued at par, redeemed at par. Can its brought down balance be different from its carried down balance? Sarmad, you're right. Now, let me clear a difference. If I purchase simple bonds, if I invest in simple bonds, at what value am I supposed to record the bonds? If I invest, in simple bonds, at what value am I supposed to record the bonds? Good, Zayan. Borsolo, not present value, fair value. Ola, not an investment cost, fair value. Hamza, not at par. Daniel, not at par, sorry. At fair value. What does IFRS 9 state? That if you acquire any financial asset, all financial assets must initially be recorded at fair value. So today, the brought down balance will be fair value. Yes. No, Jayal, sorry, I'm taking your name short. Jayal, you are not supposed to record that at nominal value. You will have to record that at fair value. Wait a minute, I've stopped my screen for a while. Let me connect it. Okay, back there. Hamza, I am not issuing the bonds. If I invest in bonds that are simple bonds, I'll have to record the bonds at what? At fair value. Remember, plus transaction cost. If you have acquired bonds, let's say if you have acquired bonds whose par value is million, but you have bought it for $1,020,000 and its fair value is $1 million, you will have to record that investment at fair value, not at cost. That $20,000 that you have paid extra over the fair value will immediately be charged to profit loss as an expense. No, Mahagandhi, we'll be recording that at amortized cost. Fair. So if I record the opening balance at fair value plus transaction cost and the closing balance will be the redemption value, even if bonds are simple, yet their opening balance can differ from its redemption value. Azhar, I would appreciate if you could drop me a message on my WhatsApp, that my WhatsApp number is mentioned in the PowerPoint first slide, because this would be very difficult for me to copy your number from here and send you the link. So I would appreciate if you could drop me a message on WhatsApp. What may possibly be differences? No, Avinash, as per IFRS 9, we can carry date instruments at three possible bases. One is amortized cost, FVTPL, FVTOCI. In case of FVTPL only, transaction cost cannot be capitalized. But in case of FVTOCI and amortized cost, transaction cost is always capitalized. Let's see. Opening balance may be different from redemption value. Bit lagging, I'm waiting. The value at which we are recording bonds today, now, this can be different from the value we'll be getting after 4 to 5 years at the date of maturity. Why? Number one, because we are initially recording the bonds at fair value. The issuer has not guaranteed you to pay the fair value back. If the par value is million, but you have bought the bonds for 1,050,000, the issuer has nothing to do with this 50,000. This is your loss. This is your risk. I have guaranteed you to pay back $1 million only. So I am supposed to record the bonds at 1,050,000, the fair value now, and I'll be getting $1 million back at the date of maturity. So the difference of 50,000 from brought down to carried down will cause the difference between effective and coupon. Number one. Number two, IFRS 9 requires that bonds must be measured at fair value and the transaction cost must be capitalized except FVTPL. Since if I have bought bonds with a par value of million at fair value of $1 million, but I acquired the bonds through a broker who has charged $25,000 from my company for this investment. Now, what's the case? Ananya, there is a great list. I'll discuss it in very short terms because we cannot spend that much time. Your intention matters. Ananya, you're asking that how can we decide that these will be recognized at FVTPL or something else? Nice, Aisha. Financial asset, Amna, we are talking about financial asset. I'm telling you that I have acquired the bonds, I have purchased the bonds. Maha, we will record the bonds at fair value, and we are not supposed to charge 25,000 transaction cost to profit or loss. No, that transaction cost must be capitalized into the cost of the asset. Getting? Osman, every participant is asking a question to answer a question, because we don't have other mode of communication here. So you can put a question if you want to answer a question. Yes, Amna. If the financial instrument, debt instrument are held for trading, FETPL, no cash flow characteristics test. If passed, move to the next model, business model test. If fails, FETPL. Business model test, there are two possibilities: held till maturity, hold plus sale. If held till maturity, amortized cost, hold plus sale, FETOCI. Okay, coming back. Yes, Maha, we'll capitalize only except FETPL. We are supposed to capitalize the transaction cost. Remember, we are recording the bonds, the investment at fair value, which has nothing to do with the redemption value. We are capitalizing the transaction cost, that has nothing to do with the redemption value. At times, the bonds are issued at discount. So you have acquired at discount, but will be redeemed at par value. This is what creates the gap between year 0 value and year 4 value. Avinash, no. IFRS 9 specifies it. IFRS 9 specifies it that except FETPL financial assets, amortized cost, and FETOCI financial assets, the cost must be capitalized. Transaction cost must be capitalized. This should not be charged to profit or loss. Fair? And what happens that these bonds may be redeemed at a premium. These are some factors that will result the opening balance of financial assets to be different from its redemption value. Why is effective interest different from coupon? Now I'm answering this. Whenever opening balance is different from redemption value, that effective interest will fill the gap. We'll have to amortize it. We'll have to make sure that the bonds are initially recorded at fair value plus transaction cost, but over the passage of time, the value of bonds must reach its redemption value. So the gap of opening balance to redemption value will be filled by effective interest rate. So clearing the confusion, what is effective interest rate? Effective interest rate is simply IRR. Zayan, very nice. Effective interest is basically IRR, nothing else. Forget the market, forget the real and nominal terms. Very nice, Pooja. The rate that will bring brought down balance of financial asset or liability to its redemption value. Sakib, fair value is value that you have paid today or the price that would be received if you sell your bonds today. Fair value is valued now. The issuer has nothing to do with the fair value. If I have promised you to pay $1 million back after 5 years, even if you buy my bonds at $1.2 million, I'll not be compensating that 0.2 million difference, because what I have promised that I'll be giving you $1 million back after 5 years. You have bought it for 1.2 million, 1.1 million or 0.9 million. I have nothing to do with that. But the investor, a company, is affected. Very nice by song. Now well taken. Whenever there is difference between opening balance of financial asset or liability and redemption value, the effective interest does the trick. So effective interest is simply what? Nothing else but IRR. Let's get back. Zayan, not necessarily that normally we use it, but this is not compulsory that we use that effect. Don't waste your time discussing something that is not important. Like in this case, I said you should highlight that there is a discussion between whether this convertible bond should be recorded as equity and liability split accounting, or whether these convertible bonds should in entirety be recorded as financial liability. Let's end the question now, because we have invested or we have issued funds at par, but these are redeemable at premium, right? Ultimately, Ola, is your connection stable now? All right. Because the opening balance of this financial liability will be different from its redemption value because of the premium. Hence, the effective interest rate will be different from the coupon, right? The effective interest will be different from the coupon. Now, it further says, accountant is unsure about split accounting. Since we are writing something, an accountant wants to be clear about the split accounting. Split accounting is the splitting of proceeds into debt and equity. But a discussion must not go that way. Since the accountant wants to know, we, in order to gain marks in paper, will discuss something about split accounting, because the examiner has highlighted that the accountant wants to know something about split accounting. Fair? Okay. The requirement is discuss. The requirement is discuss. The main requirement, majority of questions of SBR require us to discuss and calculate accounting treatment for convertible bonds for year ended 30th September 2019. I've just asked you to calculate impacts for 1 year, because we have issued bonds on 1st October 2018 and we are closing the statements for 30th September 2019. Easy? So few of you have drafted your answer. Here is my answer. Let's read this. We started discussing about IAS 32 because this is department of IAS 32 to deal with financial liability and equity, whether funds are supposed to be reported as an equity or the liability, or the split accounting should be applied. That is department of IAS 32. So IAS 32 specifies the definition of financial assets and financial liabilities and equity. The objective of IAS 32 is to establish principle for presenting financial instruments as liability or equity. Who deals with the issue? IAS 32. The classification of the financial instrument by the issuer as debt or equity can have significant impact on the entity's gearing and reported earnings and debt covenants. This is what I've copied from the article of ACCA. But sounds well if you draft your answer this way. The key feature of debt is that the issuer is obliged to deliver. Nice. Yes, Hamza. Good. At the same value. Good. Yes, nice. Okay. So the entity is obliged to deliver cash or another financial asset. Financial asset. We were discussing here that ordinary shares are what? Are financial assets, right? These are non-monetary, of course, but ordinary shares. The contractual obligation may arise from requirement to repay principal, interest, or dividends. What is financial liability? See, I have not discussed financial asset here because it is irrelevant to discuss it. It's irrelevant to talk about financial asset here. The exam question is particularly asking me to comment on financial liability and equity. So financial liability is a contractual obligation to deliver cash or another financial asset to another entity. A contract is not an equity instrument solely because it may result in the receipt or delivery of entities on equity instruments. When you observe that these bonds are convertible, that means the entity is obliged to deliver the number of shares of on equity instruments. Your brain took it to split accounting, that whenever the bonds or loan notes or any debt is convertible, your brain took it that this must be split. But the classification of this type of contract is dependent whether there is a variability in either the number of equity shares delivered or variability in the amount of cash or financial asset received. If the number of shares to be issued are fixed, it is debt and equity that must be split. It is hybrid, it is compound, it's combination of two, debt and equity. But if the number of shares are variable and dependent on the value of the shares, then this will be treated as a liability. So a contract that will be settled by entity receiving or delivering fixed number of its own equity instruments. Fair? In exchange for a fixed amount of cash or another financial asset in an equity instrument is an equity instrument. If the number of shares are what? Fixed. Yes, good. Here in this case, we are going to deliver, but IAS 32 talks simultaneously about receipt and payment, receipt and delivery. But we here must be focusing on the delivery. Let me delete this. Fine. We are talking about the delivery. This has been called fixed for fixed requirement. However, if there is any variability in the amount of cash or on equity instruments that will be delivered or received, such contract is financial asset or liability. So, fair? So such contract is a financial liability. Remember, don't directly jump to your answer. Don't directly jump to your conclusion. Bonds issued by Marine, in this case, are convertible into variable number of ordinary shares, where quantity of shares will be dependent on fair value of shares at exercise date. Bond holder will be indifferent now. Zayan, you highlighted earlier, indifferent now of equity or cash in either case, because if the date holder chooses to get cash, will still be getting the same amount. If the bond holder gets to choose, the shares will still be getting the same value. Irfan, wherever there is variability in the cash, we always choose the expected one. You do remember IFRS 16 leases, where the minimum lease payments may be different, may be subject to vary. So what we choose is for the guaranteed residual value, or if the amount is dependent on the fair value of the asset, we use expectations over there. So in case if there is variability in amount, we'll be using the expected. Sam, later on the date of redemption, the investor has choice to get cash or shares exactly of the same value as redemption. But if the bondholder chooses to opt for the number of shares, then will be subject to the dividends. But at the date of redemption, the investor will be indifferent of choice. The investor can take the cash from the company and buy the shares later. Sarita, remember, whatever the percentage is mentioned with the name of the instrument, whatever the percentage is mentioned with the name of the instrument, that is always coupon. We can see this. I have mentioned that Marine Limited has issued 8% $100 convertible bonds. Any percentage that is mentioned with the name of the instrument is always coupon. Amna, you should ignore that, because this was the question raised by someone else. This will confuse you further. So better ignore it. Okay. So at the date of redemption, Sam, you clear over this? The investor will be indifferent of choice when at the date of maturity. Later on, the investor might get dividends, might gain the capital appreciations of the shares, but that is something to be something to happen later. Yes, correct, Zayan. Is indifferent where the number of shares are variable. So must be entirely treated as financial liability. I didn't merely say that this should be treated as financial liability. Few students who submitted their answers were excited to tell that this is a financial liability. Don't draw the conclusion immediately. Discuss. If you're right, you are right. If you're wrong, you can still be right if you justify why. The key to pass SBR lies within why. Noor, what happens? We'll have to see who has the choice. If the issuer will decide whether I'll have to pay the cash back or whether I'll be converting the funds into shares, then this is not split into debt and equity. Maha, no. 480,000 is coupon. Coupon is not merely charged to profit or loss. It is always effective interest rate that is charged to profit or loss. So Noor, who has the option matters. If the investor has the choice, then we'll see whether split accounting should be used or not. If the number of shares are fixed, the split accounting will follow. If the number of shares are variable, the split accounting will not follow. That will be shown as a financial liability only. If the issuer has the choice, then we'll see the probability, what the issuer is most likely going to choose. Right? You do remember IFRS 2. In IFRS 2 share-based payment, there are three possibilities. Number one, equity settled share-based payment. Number two, cash settled share-based payment. Number three, choice of settlement. How do we record equity settled share-based payment? We credit it to equity. How do we record cash settled share-based payment? We credit it to liability. But when there is choice of settlement, how do we record it? That depends who has the choice. If the employer has the right to choose whether to grant the shares of equivalent value or to pay the amount to the employees, then the treatment is different. But if the employee has the option to choose, then the split accounting follows there as well in IFRS 2. Next, split accounting. Why am I discussing this? Because the question highlighted that accountant is confused for split accounting. So I must tell accountant what split accounting actually is. I'll be getting marks for this as well. Split accounting applies to the compound instruments where the holder of the bond will get fixed amount of issuers equity instruments where the number of shares are fixed and has the choice in hand. Who has the choice? The holder. If the holder has the choice in hand, then there will be discussion regarding split accounting and liability. Amount raised is split into debt and equity at the date of issue. This is what I've written for the accountant to be clear about this. Next, split accounting. Why am I discussing this? Because the question highlighted that accountant is confused for split accounting. So I must tell accountant what split accounting actually is. I'll be getting marks for this as well. Split accounting applies to the compound instruments where the holder of the bond will get fixed amount of issuers equity instruments where the number of shares are fixed and has the choice in hand. Who has the choice? The holder. If the holder has the choice in hand, then there will be discussion regarding split accounting and liability. Amount raised is split into debt and equity at the date of issue. This is what I've written for the accountant to be clear about this. Marine is obliged to pay 8% coupon interest every year on par value, and coupon always applies to par. Remember, coupon never applies to brought down balance. Coupon always applies to par. So this would be $480,000. This is the amount we are supposed to pay. But bonds are to be redeemed at premium of 5,56,920, resulting in effective interest of 10% per year. No, Hamza, we are not supposed to go that way. What factors would investor consider when choosing for debt or equity is not relevant here. What we are concerned about is merely the accounting treatment. We are financial accountants. We are not financial managers. Yes, Irfan. Irfan says that if the question mentions that the shareholder will get double of the redemption value, Irfan, see, it's very clear. If you tell your investors that you can either choose $1 million or you can get shares worth $2 million, what do you think will investors choose? It's very obvious at the very day first. If you tell investors that you can either get cash of $1 million or you can get shares of double value than $1 million, it's very obvious they will opt for the shares. This is treated in equity. When you are sure that investors will go for shares, not for redemption, there is no point of paying the cash back. When you are not obliged to pay the cash back, this is not a liability. Understanding? Because you are keeping it contingent on the value of shares. Safi, you're asking if is there any cost of time we can, when we get cash today and issue shares after 1 or 2 years, we get benefit from the cash. Yes, Safi, if I tell you that Dinesh Limited wants to issue shares, please give me $1 million or $100,000. I'll be giving you shares after 1 or 2 years. Will you be comfortable giving me cash? Maha, these $600,000 are effective interest on brought down balance. How many number of bonds have we issued? 60,000 multiplied by $100 multiplied by effective interest. Easy, Maha. Safi, I am telling you that I'll be giving you shares after 2 years. But give me money now. Would you give me money? I'm not giving you any shares right now. If yes, these shares are not vested. You cannot exercise the voting power. You'll not be subject to any dividends. You'll not be subject to any bonuses or rights I issue during in due course. Getting? So there can be an advantage, but investors will never choose this option. You are comfortable with this, but investors will not give you cash in advance for the shares to be issued later. Investors will try to get shares immediately, right? Fair. Sona, you're asking me to focus on derivative and hedge accounting. I personally believe that covering topics will be very difficult for us because this time is very short, total 15 hours, and we are left with few. I'll see if I could guide you personally. You can drop me a message on WhatsApp. If you are facing any specific troubles, I'll try to be of your help privately. But we cannot utilize this webinar for covering of any topic because this time is very short, right? So I'll try to help you out in case you need any help privately at no extra cost, of course. All right, so we'll be charging $600,000 to profit or loss as finance cost. $400,000 are supposed to be paid as coupon, and 120,000 will be added, amortized into the value of liability. Merely performing calculations will get you no marks, right? Merely performing calculations will get you no marks at all. So you must try to learn how are we answering. Let's see, quickly review the discussion paper. This is relevant for June 21 attempt, where like discussion paper 2018/1, the name of this is instruments with characteristics of equity. If we issue any instrument who has characteristics of equity, how are we going to deal this? Taking some time to talk about sukuk. You people know well, if you have learned in F9 in financial management, sukuk are Islamic bonds. Although these are bonds, but these are Islamic bonds. The issuer can never guarantee a fixed return because that will be riba, interest. And interest as per Sharia in Islamic principles is forbidden. What I issue sukuk as that you are supposed to give me your money, I'll be investing the money in a certain project, and the return I'll be getting will be divided to all bondholders, but you can get it redeemed. Now this can be an instrument with characteristics of equity. So this discussion paper focuses how can we learn whether this is debt. Discussion paper says, is the redemption at the option of the instrument holder? Who chooses? If the holder chooses the redemption or conversion option, this will decide whether this is a debt or equity. Is the instrument redeemable? If the life of the instrument is limited and it is redeemable, this will be debt. If it is not, if it is irredeemable, like irredeemable preference shares, this will be classified as an equity. At times, few things happen due to uncertainties. In case the business is winded up, is closed. So this is an uncertain event beyond the control of the holder and issuer. Even the ordinary shareholders can get some money back from the business in case of liquidation. Even the irredeemable preference shares can get some money back in case of liquidation. But liquidation cannot help you classify either debt as an equity or an equity because we are assuming going concern concept. Next, are dividends discretionary or non-discretionary? Discretionary is at the free will of the management. If these are at the free will of the management, this is purely an equity. But if these are non-discretionary, the management has to pay, then this would be meeting the characteristics of debt. So there are confusions surrounding. Irredeemable preference shares should be classified either equity or debt. There is a confusion, remember. Similarly, the discussion paper discusses other factors that may result in instrument be classified as equity are whether the shares are non-redeemable, If these are redeemable, that is a date. If non-redeemable, that is equity. Whether there is no liquidation date, the company is going concern, then this is equity. If the company is not no more going concern, is supposed to cease after certain time, then this would be converted into liability, or whether the dividends are discretionary. You must go through the article issued by ACCA over this discussion paper, because you might be tested for this. Moving forward, few of you people have answered this. Winterfell Limited is an electric appliance company. I mentioned this is an electric appliance company. This is not a money exchange or something. Right? Now, what's the case? During the year ending 31st March 2021, Maha, you might be given a situation in question number 4, specifying that there are few instruments who have got the characteristics of equity, rewarding you 4 to 6 marks. This might ask you, how would a company judge whether an instrument is a date or equity? The points I have mentioned in this PowerPoint can be helpful for you to mention over there, that these factors will help a company determine whether the instrument is debt or equity, because these are the points being discussed in the discussion paper. Yes, Safi, good. The simple formula is redemption, but there are other factors following as well. Who has the choice of settlement, and are the dividends discretionary or non-discretionary? Fair. Winterfell Limited has invested a significant amount in gold bullions, considering it as a safe source and long-term value gaining. So Winterfell here is not goldsmith, is not the broker of gold. Value of investment has raised since its purchase date, but accountant is unsure about how this treatment in financial statements. How to treat? Yes. The accountant thinks it should be treated as an investment property, but doubts it does not meet the definition of property. Can you now tell me what is the definition of property only? Not investment property, property only. What is property? Quick responses, please. What is property as per IAS 40? Very nice, Dayan. Good, Sally. Very nice, Safi. Dhwani, okay. Ola, not just land. Sakib, good. William, good. Nice, Sarmat. Botsalo, nice. Samuel, don't go for capital appreciation now. I'm asking about the property only. So the property as per IAS 40 is land, comma, building, or part of land or building, or both. You must pitch the complete definition specified by IAS 40. What is important? The asset and its characteristics are not important for the treatment. What is important is your intention. If I ask you, if a company owns a property, which standard should be applied on the property? If a company owns a property, which standard should be applied on the property? That does not depend on the, if the property is useful. Yes, very nice, Maha. If the property is useful for factory, for business operations, for godown purposes, for administration purposes, for marketing purposes, then this will be classified as under IAS 16. But if the company has the property with an intention of rental income, capital appreciation, or both, rental income, capital appreciation, or both. The property doesn't matter, the intention does. So those telling me that property should be classified under IAS 16 are not satisfying. Although may be correct, but be subjective, not objective. So the meeting of definition is not important. A common example which is very famous now. Which standard deals with biological assets? Which standard deals with biological assets? IS 41 now. Nice. But see here, I'm getting you there. The biological asset doesn't matter. The biological asset doesn't matter, but its intention does. Which companies will apply IAS 40? Those involved in agricultural activity. Please note this. Companies involved in agricultural activities will record the biological asset under IAS 41. A simple example that is very common now. How would a company, let's say a security company, owning security dogs, a security company with watchdogs, how would the watchdogs be treated in the financial statements? This is a very common example. Good. A very common example. Although the watchdogs are biological assets, but the nature and characteristics of the asset are not important, but the purpose must be served. Saqib, watchdogs are your asset, right? These are not an expense. But if the company involved in breeding, right, involved in breeding, is involved in agricultural activity, then that would be classified as under IAS 41. You know well about bearer plants. Maha, these will be non-current assets. You can predict the life of an animal. We have got researches. We know life of almost every animal, not with 100% surety, but we can estimate the life of watchdog, or we can simply justify that for how long will these dogs be useful. After a certain age, when they grow old, then they'll no more be useful for the company. So company decides in advance that till what life will the company be using these dogs. Fair. Bearer plant. Bearer plant is not under IAS 41, Sarma. Very nice. This is under IAS 16, although this is a biological asset. Animals owned by zoo. Aisha, land will always be treated under IAS 16 if you are using it for business purposes. If you have produced plants on the land, the plants will be classified as under IAS 41 and the land will be classified as under IAS 16 because you are carrying out your business operations over that. Animals owned by a zoo, which standard would apply? Amina, watchdogs are treated as under IAS 16. Right, Amna? IAS 16 applies to the watchdogs by security company. Good. Animals owned by zoo is a property, plant, and equipment. Though these are biological assets, remember the definition does not matter. The characteristics of the asset are not important, but your intention is. Owner occupied hotel. Hotel is for the purpose of rental income, right? Hotel is for the purpose of rental income. Yes, Noor, correct. So if the zoo is breeding the animals, then IAS 41 would apply. That is an agricultural activity. Hotel is for rental purposes. And IAS 40 says any property held for rental income and or capital appreciation must be treated as under IAS 40. Hotel is always for rental purposes, isn't it? I've zoomed it a lot. You're not able to see my screen. The lady is fine now. Yes, good, Ola. This is owner occupied. Hotel is ordinary course of business. Fair? Glory, sorry, it's Ola. Glory. We are just finalizing the crypto and gold things. We'll be moving towards IAS 8 now, not towards consolidation today. Glory. We are not moving. We are not supposed to move towards consolidation today. Fair. So hotel will be classified as under IAS 40. Telling you very clearly, you should be very clever to understand that the characteristics of the asset does not matter. The intention does. Yes, we'll start consolidation, but today I believe the time will not be manageable. We'll start consolidation tomorrow. No, Amina, owner occupied hotel will be treated as under IAS 16. Yes, Ola, IAS 16, not IAS 40. But you must be able to discuss. Fair. The company has acquired gold, but interestingly, there is no standard covering the investment in gold. What you are supposed to do, you are to construct an answer that satisfies the examiner. You will be getting marks for the discussion, not merely for the conclusion. Let's see this now. I would appreciate if you would have formed your answer yourself, but there are very few students who send me their answers. Winterfell has invested in gold. Could be, this could be IAS 2 if Winterfell Limited is broker of gold or goldsmith, right? I have told you that Winterfell is electric appliance company. The main business operation is not to deal in gold. So this cannot be classified as under IAS 2. This is not your inventory. And you have acquired gold for long-term capital appreciation. Let's start constructing a response that how would you respond this? Yes, this is an asset, but under which standard, Jaya? Yes, sure, Naledi, I'll share these answers. Possibly, Safi, a nice discussion. Safi says that gold should be classified as a financial asset. I agree. I agree. Your discussion will gain the marks. Your conclusion will not. Jaya says gold should be classified as under IAS 40. You are also correct. But let's start discussing. Right? How would you pitch your answer? Treatment in financial statements for investment in precious metals like gold, silver, or platinum is not treated by any IFRS currently. IAS 8 says if you want to determine the accounting treatment of any particular transaction, what you will get through is the applicable accounting standard. But in case there is no accounting standard dealing with it, the management judgment must apply. The hierarchy is number one, similar standards dealing with the same issue. Number two, conceptual framework. Number three, other standard setting bodies or industry practice. Investment in gold by Winterfell is to keep its investment safe and benefit from value appreciation that may sound similar to investment in financial instruments. Fair? Then I'm telling you, with no contractual cash flows, say ordinary shares of company that doesn't normally pay out dividends. What happens when we acquire shares of a company that does not usually pay dividends? There are no contractual cash flows in case of ordinary shares as well. Sali, I appreciate. Jaya, yes, we can agree for IFRS 9. Noor, makes sense. Yes, you can start with the definition of an asset. But if there is a confusion, if you believe that there is a confusion whether the gold should be treated as an asset or not, then you should go that way. But if it's categorically an asset, you should not go that way. If the examiner sets a scenario where there is confusion between capital expenditure and revenue expenditure, when the confusion is being created whether the asset should be capitalized or not, then it is better to discuss the definition of an asset. Let's say our company makes a YouTube channel, right? Company introduces some videos, shooting it with some celebrities, filling it some with music to get more subscribers. Company believes that in future that YouTube channel will help marketing for company's activities and may be monetized in future. Now I'm creating a situation. In the situation of YouTube channel being made by a company creates a confusion whether should the company capitalize its YouTube channel as an asset or the cost of the designer or the cost of producing music, cost of recruiting those celebrities, cost of getting the subscriptions and boosting the channel. Should this be treated as an intangible asset or should that be expensed out immediately? Getting? Yes, IAS 38 is applicable. So one who was asking that should I start with the definition of an asset, when you believe the scenario is confusing you whether this is an asset or a revenue expenditure, then it is better to start with the asset definition of an asset. In case of gold, there is no confusion whether the gold is an asset or expense. it is categorically, it is very straightforward that gold is an asset. Since there is no confusion over the gold being an asset or expense, we should not go that way. Here, the main problem lies with under which standard should the gold be treated, right? It is an asset, no confusions. Yes, Safi, we'll be discussing ethical areas and on day 4. On day 4. Fair. Coming back here. But financial instruments are contract arrangements that give rise to financial asset for one entity and financial liability or equity for another. But in this case of investment in metal, there is no agreement with any counterparty. Now I'm telling you this, that gold is not meeting the definition of financial instrument. Doesn't mean I don't want to treat that as a financial asset. I'm just discussing that gold could have been treated very clearly under IFRS 8, IFRS 9, but provided it was a financial instrument. Since we can see the gold fails to meet the definition of financial instrument. Get a step back. Accountant of Winterfell believes that this should be treated as investment property, but this also fails to meet the definition of property as land, building, or part of land or building, or both by IAS 40, because the gold, of course, is not a land. Hence, we tried to use IFRS 9, but the definition was not met. Reverse. We entered into IAS 40, but gold is not meeting the definition of property. Step back. Now, since no standard is specifying the treatment of gold, where should we go? IAS 8 says, since the treatment of this transaction is not specified by any financial reporting standard, International Accounting Standard 8, accounting policies, change in accounting estimates, and errors must be applied to find the ways out. The standards are silent on the treatment, right? The standards are silent on the treatment. When the standards are silent, where are we supposed to head? To develop our own standards. Yes, Safi, you are telling me if we are hedging the gold, that is a fair value hedge, that will definitely, the derivative will definitely be classified as under IFRS 9. But IFRS 9 tells us what? The hedged item and hedged instrument, both will be treated as per IFRS 9. Can we ever revalue inventory to its fair value? Not at NRV. I'm not asking about NRV. Can we ever revalue our inventory to fair value? What are your takes? What are your views? Can we revalue inventory held for sale in ordinary course of business to its fair value? No, correct. But in case you have hedged that inventory, in case you have hedged that inventory will be treated as per hedge accounting of IFRS 9 and will be revalued. Case number 1. Possibility number 2. When parent takes control of a subsidiary, when parent takes control of the subsidiary, all net assets of subsidiary must be revalued, including its inventory, right? So there are some exceptions. Gold, if hedged, will be treated as under IFRS 9 if hedged. We have already bought Safi. The inventory we have already bought and we enter into fair value hedge. We already own the inventory and we have entered the fair value hedge. Yes, Sally, why not? That would be possible to explain as per the marking scheme. We'll see how many marks are being granted, of course. Okay, moving forward. Winterfell's main business activity is dealing in electric appliances, cannot therefore be dealer or the broker of gold where IS2 would have provided guidance. Made clear? I just touched and left. I'm not spending my time discussing IS2. Investment is with intention of value gain or capital appreciation, which is similar case with land acquired for long-term capital appreciation as IS40 investment property. This can also resemble with investment in equity shares of other entity acquired with analysis and intention of capital appreciation. Classification of investment in gold as investment property, fair value model, or FETPL IFRS 9 will serve the purpose. This is my conclusion. If I'm right, I'm right. If I'm wrong, I can still be right if I have justified why. So I can either take investment in gold as under IS40, or I can take the gold as a financial instrument under IFRS 9. In either case, in both cases, gold is neither meeting the definition of property nor it is satisfying the definition of financial asset, but the purpose is served. What will happen under IS40 fair value model? The gold will be revalued to fair value and any gains and losses are taken where? To profit or loss. The gold will not be depreciated. Ultimately, this can never be depreciated because gold has indefinite useful life. What will happen if we carry this as under IFRS 9? The same rule will apply. Right? The same rule will apply. Amina, I appreciate. Let me come to that. Hamza. Okay. Yes, yes, Maha. You have mentioned it earlier that we are determining the treatment of gold as under IS 8. Sarman, why do we keep investment property at fair value as IS 40 and property for business use as under IS 16? Is fair value and revaluation model of IS 40 and 16 same? No. When the property is acquired exclusively with the intention of capital appreciation, the differences should be reported to profit loss because this will help us serve the purpose. If you have acquired your property with a view of capital appreciation, the gains and losses must be reported to profit loss because this is why the management has acquired it. But under IS 16, the property is not acquired for capital appreciation intention, but if it is gaining value, this should be reported as under IS 16. Here the gold is acquired with what intention? For capital appreciation. You can discuss taking this to IS 16, not an issue, but you can pull it out that since the gold is not acquired for the business use, it is for the capital appreciation, then treating this as under IAS 40 will serve the purpose better. Safi, I have that list. Safi is asking me to discuss the factors that will be taken or the items that will be taken to other comprehensive income. I have kept this for my upcoming sessions. In the question of consolidation or question number 2, I will be discussing this. Yes, I have set a question for this, a very important area. Maha, if you are using FVTPL under IFRS 9, the value changes will be taken to profit or loss. If the management believes that these uncertainties in the or the fluctuations in the value of the gold will affect my performance, will affect the performance of my company, and the company chooses the fair value model, FVT-OCI model. You do remember, if a company acquires shares, equity instruments of another company, these are normally treated as under FVTPL. But there is an option, there is a choice, irrevocable election. If a company wishes to avoid its profit or loss being affected by these fluctuations, then the company may choose FVT-OCI model. For the gold, you may discuss the same. If the company is cautious about the impact of gold fluctuations on its profit or loss, the company may be allowed to choose other comprehensive income model. Clear? Amna, I missed your question. Let me get back to it. Yes, Amna. So you were asking that why don't we keep it at FVT-OCI? We can. If the management wants to avoid the fluctuations into profit or loss, then the management can choose the other comprehensive income option. Sarmat, if treating gold as under IAS 16 serves the purpose, then you can. But since we are not supposed to use gold for business use, we are not constructing our property with gold. Even if we acquire a car that is made of gold, then this makes sense to keep it under IAS 16. But since the gold has been acquired with an intention of capital appreciation, then this would be better to deal as under IAS 40 or IFRS 9. Yes, Mohit, the management can choose to book the profit, but your treatment is your treatment. The discussion will gain you marks, right? Fair. Moving forward. Next question. King's Landing. The company has done what? Has invested in cryptocurrency. Although I believe this is not part of our syllabus, but the examiner may expect from you to be able to discuss crypto. Anyone? Hamza, we are not treating it as held for trading. Those instruments that are held for long-term capital appreciation can still be classified as under FVTPL, right? Because the FVTPL option is always open. Fair. Coming back to Yes, Sally, that is very important. You are telling that the marking scheme will be important to answer the question. Yes, of course. The amount of marks or the benefit of the marks will be important to check when you are supposed to write an answer. The question rewarding more marks needs more discussion, of course. Where should and how should the crypto be dealt? We have read many articles, and the interpretation issued by IASB states that cryptocurrency should be dealt with as under IAS 38, right? Cryptocurrency should be dealt with as under IAS 38 merely because it is meeting the definition. But we have just discussed the definition is not important, the intention is. What has happened here? Fine, Safi, but why have you bought cryptocurrency? Why has King's Landing invested in cryptocurrency? That is meeting the definition of an intangible asset, no denials. But just because it is meeting the definition of an intangible asset, treating this as an intangible asset seems unjustifiable. If this is the rule, then watchdogs must be capitalized as under IAS 41 because they are meeting the definition of a biological asset. But what is your intention? Matters, right? The definition merely is not important. So King's Landing has invested some amount, $12 million in Bitcoin, and this is working on blockchain technology, distributed ledger technology. You must be aware of this. Do some research on this. Your generation must know what is crypto, right? Then whether you support it or not, that is another thing, but you must know what the cryptocurrency is and is traded on reputed crypto markets. Company has planned to set aside this investment for long term as its value is expected to grow in future when this will be expected by many businesses as currency. So what King's Landing is expecting that crypto will be accepted as a currency. This will be treated as a cash, but this will be maybe in future. Nothing can be said now. The idea behind the creation and the development of this crypto is that this will be treated as a currency. But let's see what happens in future. And this will be exchanged on exchanges, currency exchanges and money exchanges. Let's see if that actually happens. For the year end 31st March 21, the directors believe this should be treated as a financial asset. Please don't be very conclusive about the answers that you have read on the articles. Structure your answer, right? Structure your answer. Be smart. Crypto can be treated as under IAS 21. Crypto can be treated as under IAS 7, cash equivalent. Investment in crypto can possibly be treated as under IFRS 9, financial instrument. And this may possibly fall under the definition of IAS 38, intangible asset. Don't be judgmental. Start discussing about IAS 7. Fail the criteria, go back. Start discussing about crypto under IAS 21. Fail the criteria, go back. Start discussing about IFRS 9. Start discussing about IAS 38 and stay where you want to. Your answer must not exactly be same as examiner. Don't copy. Follow the good game. Don't support the player or the team. Don't be biased. So how should crypto be dealt under financial statements? In the financial statements, let that be your decision, not what you have read. Getting my point? Your discussion will earn you marks. Let's see how have I structured this. I did receive answers from many students, and few were written well and few need improvements. Hassan, not an issue. Not an issue. The examiner wants you to be expert in discussing. They have issued an article, but that is not part of our syllabus and that is not determined by IASB yet. If there was a standard, then they would be in jeopardy. But these are just discussions, and the article writers are tutors as well. I can write an article on ACCA. Getting my point? Your discussion will gain you marks. Fair? Let's see how should we deal this. I'm telling you very clearly in SBR, if you are right, you're right. If you are wrong, you can still be right. You can use your knowledge, but any scenario might be tested in the exam for which you don't have deep knowledge of the accounting treatment. I am making you able to develop your own accounting treatment. Let's start reading it very fast. Cryptocurrency is an intangible digital token that is recorded using a distributed ledger infrastructure, often referred as blockchain. These tokens provide various rights of use. For example, cryptocurrency is designed as a medium of exchange. Other digital tokens provide rights to use the assets or services, can represent ownership interests. If we have invested in crypto, we have got the ownership interest in crypto. At first, it might appear that cryptocurrency should be accounted for as cash because it is form of digital money. However, cryptocurrency cannot be considered as equivalent to cash or currency as defined by IAS 7 and 32 because they cannot be readily exchanged for any goods or services. What is cash? That is exchanged against goods and services as a barter. The idea and the vision behind crypto is this, but till date, this is not the case. The crypto is not being accepted. Yeah, the crypto is not being accepted as a currency. So increasing number of entities are accepting it as a payment. You heard about the Tesla, about the Elon Musk tweet. They announced that they'll be accepting this, but later on they denied. Digital currencies are not yet widely accepted as a medium of exchange and do not represent legal tender. There is no counterparty, right? Entities may choose to accept digital currencies as form of payment, but there is no requirement to do so. Normally in jurisdictions, it is well defined that companies must accept dollars, dirhams, ringgits as a currency. But here, in case of crypto, we cannot be forced to do so. Point number 2, IAS 7 defines that cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to insignificant risk of value changes. This is discussion, remember, don't conclude. Thus, cryptocurrencies cannot be classified as cash equivalent because they are subject to significant price volatility. Therefore, it does not appear that digital currencies represent the cash and cash equivalents that can be accounted for under IAS 7. Next, investment in crypto for capital gains may also sound similar to investment in financial assets. But as far definition is concerned, it fails to meet, right? Because financial asset is a contract that gives rise to financial asset for one entity and financial liability or equity for another. Normal currencies are treated as financial asset because there is a counterparty, which is a central bank. But in digital currency, these are decentralized instruments where there is no counterparty. So the definition of financial instrument is not met. Generally, currencies are traded as monetary assets because of the determinable value in fixed currency units, while value of cryptocurrency cannot be fixed currency units due to lack of counterparty. Therefore, possible treatment as under IS 21, this can also not be treated as a foreign currency. Okay? Like, can you understand? I'm starting to discuss something, then supporting it or denying it. Applying definition of intangible assets under IS 38, identifiable non-monetary assets without physical substance, seems to meet with characteristics of digital currency, as these coins can be separated from rest of the business and does not have any physical substance. Here, the definition of intangible asset is satisfied, right? The definition of intangible asset is satisfied. Naledi, what do you mean by why buy crypto? That is a value gaining currency. Sefi, yes, if it is backed by the central bank, if it is backed by the central bank, this can be accepted as a financial asset, of course. Good, Sefi, I support this because we are not carrying out our business operations with the cryptocurrency. So treating this as an intangible asset under IS 38 is not what I'm convinced with. I'm not convinced with. Yes, Naledi, crypto is not acceptable right now, but it is gaining its value. So majority of people and investors are investing in cryptocurrency because there's a limit on mining, and anything whose supply is limited, the demand increases and the value increases. Sam, this or my answer can be the best practice possibly. I'm just making you able to see that what aspect in the question shall you be discussing. You must not discuss all this. Remember one thing, you must be smart when answering a question. Don't start typing immediately after reading the question. Don't start writing immediately after reading the question. Give it 2 to 3 minutes to structure the answer. Which areas shall you be touching? And then structure the answer in your mind, then start writing this. Getting? Reality, there is a possibility. I support this can be treated as under IFRS 9 and equity, but this is not equity for any other entity. This is not meeting the definition, but this will serve the purpose. Mohib, yes, but do you believe the cryptocurrency has a life? This is an intangible asset with indefinite useful life. So this cannot be amortized, but impairment test must be performed. Its open market fair value is reasonably available. Amina, if you have acquired crypto for capital gains, wouldn't you be interested to report the gains and losses in profit or loss? Because this is why you have obtained, this is why you have invested in crypto, because you want to benefit from its value gain. But if again the management wants to be cautious and doesn't want to affect its profit or loss, the fair value other comprehensive income option may be available. Nothing, Safi, nothing. You are telling me that what is security at the back of crypto? There is nothing. There is no collateral. There is no counterparty. So you are totally at risk. George, you're asking me that how the mobile money by the central bank be treated as financial in financial statements. This case seems very similar to the loyalty points. But if that electronic money is cashable, if this can be exchanged against the goods or services, if a customer in the bank or in the telecom company has the balance in its SIM and the customer can use it against the services of the company, then the mobile money as cash equivalent, because the company is exchanging that prepaid balance or the mobile money as cash equivalent against the goods or services the company is providing. Normally, the topped up amount that by the customer shall be treated as prepayment by the customer and unearned income for the company. If the customer tops up balance credit in its SIM and has not yet enjoyed the services for the credit available, this should be treated as unearned revenue by the telecom company. But since the company allows the customer to enjoy the services against the prepaid balance, this will later on be treated as cash equivalent because the company is accepting it. Maha, that much calculative. See what relevant answer can you type. If you believe that putting discussion on certain item will be helpful for you to draw a conclusion, discuss it. Akis, problem with the crypto is that as per IS 38, this will be classified as under revaluation model, and revaluation model of IS 38 requires the gains to be taken to other comprehensive income, not to the profit or loss. George, could you understand the answer? Okay, let's see. Let's read further. Treating investment by King's Landing as an intangible asset and using revaluation model can be fair judgment. Fair judgment, fine. But any upward revaluations are credited to other comprehensive income as per IS 38, which seems to fail the purpose being served. My understanding, right? My understanding. The company has invested in crypto for capital appreciation purposes, and you are treating it some way that is not reporting the changes in profit or loss, right? If that is the case, George, if the partner banks are holding the e-cash and the company has not obtained anything, how can telecom company record anything? But I would appreciate if you could clear your case in your private WhatsApp message, because I'm getting plenty of discussions here and questions, so I'm missing out some points here. So we can discuss it privately. I can learn something from you, or maybe I could guide you. Moheb, as per IAS 38, we can not take the fair value changes to profit or loss. The downward revaluation can, but the upward revaluation changes cannot be taken to profit or loss, right? So choosing IS 38 and determining our own accounting treatment under that IS 38 cannot be an option. You better choose a different standard. But what IS 38 says, you have to follow it. Maha, don't be again calculative. See how much constructive discussion can you put in? A student cannot be very judgmental during 3 hours exam. Remember, your brain, the condition of your brain right now will not be same as your condition of brain in your exam. This will be totally different. You'll be having pressure. So you cannot think that being very calculative. So you better construct what can you put in your answer and hit it. Safi, if a company accepts this as a payment, this can still not be treated as cash equivalent, but we can treat it as a short-term financial asset, financial instrument. We must carry cryptocurrency at fair value, right? With the changes being taken to profit or loss. This is my belief. So treating as an intangible asset will not serve the purpose. Merely meeting the definition cannot finalize its accounting treatment. My wording, right? As per my understanding, treating cryptocurrency as FVTPL under IFRS 9 will result in better and fair presentation of investment. Satisfied? Please learn that I am telling you to be able to discuss. This is what will gain you marks. Sam, even if you hold something for long term, if I ask you, land held for long term capital appreciation, Sam, right? Land held for long term capital appreciation, which standard do you think would apply? Land held for long term capital appreciation, IAS 16. Sali says it's IAS 40. Others might respond, yes, 40, 40, 40. Sam, are you sure about IAS 16 now? IAS 40, and this is specifically mentioned by IAS 40. Land acquired for or held for long-term capital appreciation is treated as under IAS 40 investment property, and the company uses fair value model. Where would the changes be reported for the land fluctuations? As per IAS 40, where would the changes in value of land be reported? Of course, in profit or loss. Come on, who is saying OCI? Sabina, are you this? Sabina, PNL, yes, true. IAS 40 fair value model reports all the changes in investment properties value to profit or loss. Sam, isn't that for long-term capital appreciation? Hamza, we can say that crypto is very similar to land, with the only difference being the land is physical and crypto is digital. Fair? So everything that is held for long-term capital appreciation must not be treated as under FVTOCI. It's not required by IFRS 9. Good, Safi. So this was my conclusion. I'm telling you, this is different from the interpretation committee's answer. This is different from technical articles answer. This is different from IFRS box, CPD box, Sylvia. But my answer is my answer. If I am justifying why. Sam, those investments where the company does not wish, where the management does not wish their profit reported to be volatile. If I believe that reporting any gains or losses into profit or loss will make my profit or loss volatile, then the company may choose other comprehensive income option. Right? The management is trying to avoid the fluctuations in a statement of profit or loss, then the company may choose what? Other comprehensive income option. Forward. IS 8, can a company? Yes, yes, yes. That is volatile. Cryptocurrency is volatile. Yes, of course. So if a management doesn't want its profit or loss to be affected by its volatility, then uh, other comprehensive income option can be exercised. Yes, it is irrevocable election, George. True. Company once chooses other comprehensive income option cannot get back to amortized cost or FETPL. It is irrevocable election. True. But this all depends on the management's intention. If the management wants to report this fluctuations into its profit or loss, then FETPL will serve the purpose. But if the management wants to avoid fluctuations in its regular profit or loss, then the management may choose other comprehensive income option. If there is a change in accounting policy, there can be if it is required by IFRS, then we'll have to change it, or the company has option to change its accounting policy if this results in more reliable information, right? So this can be required or this can be voluntary. When a company changes its accounting policy, how should this change be accounted for? Whenever a new standard is in place, whenever there is new standard in practice, there are always transitional provisions. The standard tells you from which date should this standard be applied and how should the previous years be affected by this change. In case the transitional provisions that does not specify, then a change in accounting policy must be accounted for retrospectively. You must be very clear about retrospective change and prospective change, right? So for retrospective, we assume that this change took place certain years back. I have mentioned that change from cost model to revaluation model under IS 16 is not a change in accounting policy. This is specifically excluded by IS 8. Sorry, not IS 18, my mistake. Sam, maximum practicable years. Sorry, Priyush, I just mentioned this is not 18. This is IAS 8. My mistake. This is typo. Happy? Yes, fine. If there is a change in use, Safi, if there is a change in use, then it is compulsory to show that as under different standard. That would be departed from the previous standard and reported as under new standard. But if there is a change in intention, change in use, right? That is not a change in accounting policy. There is a change in use. Example, Whale. Whale Limited entered into an operating lease on 1st January. Mohit, if the retrospective change is not possible, you will apply it prospectively. Number 2, as per the exposure draft of IS 8, there should be a cost benefit analysis. If the cost of retrospective treatment exceeds the benefit of retrospective treatment, then this should be applied prospectively. the IAS 8 is now supposed to be bit flexible in near future. So maximum possible practicable level, you will adjust current year, you will adjust comparatives and opening returnings of the comparators if practicable. Let's see this question very quickly. Yes, we'll see the cost. George, in case of errors, that depends on materiality. If the error is of significant nature, the error is corrected retrospectively. But if it is not that material, if it is immaterial, then we'll be accounting for it as prospectively. So for error, what matters is significance. Well entered into a lease, which lease? Operating lease on 1st January 2017 for 5 years to use a machine having estimated life of 10 years. Whale paid $3 million as upfront payment and agreed to pay $2 million every year as at 31st December in arrears. Whale has treated this lease as operating lease up to 31st December 2018 as per IAS 17. Do you people know how is operating lease treated by lessee? Not as per IFRS 16, I'm asking. I'm not asking as per IFRS 16, please. As per IAS 17. How would lessee show operating lease? Nice. Yes, Zion, you are true. Lease rentals are expensed out. Very nice. But on a straight line basis. But on a straight line basis. Yes, good, Hassan. So here in this question, I'm doing what? The company was earlier applying IAS 17, but there has been an issue of IFRS 16 from 1st January 2019. The company has to report the asset as per under IFRS 16 for 2019. So in 2019, there is a change in accounting policy required by IASB. Hamza, there is a difference between operating leases and finance leases, please. As per IFRS 16, from lessee perspective, there is no difference. From lessor perspective, operating lease and finance lease are different. I am talking about IAS 17. The company has paid how much? $3 million in advance. How would you charge this $3 million to profit or loss? Any idea? How would you charge this $3 million to profit or loss? On a straight line. How? On a straight line basis. As per IAS 17, operating leases, we are supposed to calculate the total payments. We are supposed to calculate what? Total payments. Please help me out. We are supposed to pay $2 million every year for how many number of years? 5 years. 2 million multiplied by 5. How much is that? 2 million. Hamza, I'm trying to explain you the change in accounting policy. How would that be accounted for? Very nice. $10 million. Plus, how much have you paid in advance? How much have you paid in advance? 3. Good. So total payments are 10 plus 3. 13 million. Very nice. And how much is lease term? 5 years. Good. 13 divided by 5. How much is per annum? Excellent. 2.6 million. Excellent. 2.6 million. Now, what company has done? We have entered into lease on January 2017. Our first year was 31st December 2017. Our second year is 31st December 2018. How would the accounting treatment be? How would you have treated this? Structure the answer in your mind. For 2 years, how do you think would this have been treated? Expense of. And how much expense would you have shown? Good. And how much payment have you made? Expensing 2.6 million per annum, right? Jaya, it's 5.2. Yes, good. It's 5.2. Very nice. 2.6 every year. Good. 5.2. So what double entry would you have made so far? How much payment have you made? 3 million, 2 million, 2 million, 7 million. 3 million in advance, 2 million for the first year, 2 million for the second year, right? 7 million in total. And we have charged to expense as 5.2 million, right? Can you get me? How much have we paid the cash so far for 2 years? 7 million. And charged how much to profit loss? 5.2 million. There would be a prepaid rent in the balance sheet. Out of $7 million, out of $3 million advance, how much have you charged to profit loss? Out of 3 million advance, how much have you charged to profit loss? 1.2. Very nice. So there is prepaid rent of 1.8 million. Perfect. This is how statements are being shown, right? Jaya, I'm talking about 2 years, 2017 and 18. How much cash have you paid? $3 million in advance? Right? And 2 million per annum for 2 years. It's 7 million. All right. But the standard requires us that from 1st January 2019, IFRS 16 must apply. And as per IFRS 16, from the perspective of lessee, there is no difference between operating leases and finance leases. Can you please help me calculate at what value should I debit the asset? Will I debit the asset? Do I have to debit the asset as per IFRS 16? Yes. Which asset? Right of use machine. Very nice, Sam. Good, good, good. Noor, very nice. Right of use asset. But under IFRS 16, for liability, right? First, we are supposed to calculate what? Lease liability. Very nice. I'm sparing you time. Yeah. So it's trying to reestablish. Sakib, I'll check to it. You have told me that the 7.8 now. Okay. So I can see that the audio has been restored. Fair, Zayan, a good idea. Let me stop my camera for a while. Easy. Okay. So how much would be the lease liability? Could you calculate this? As per IFRS 16, and assuming that IFRS 16 was in place on 1st January 2017, Mohammed Safi, I was telling you that as per IAS 17, lessee had a difference between operating lease and finance lease. Now, as per IFRS 16, there is no concept of operating lease. Only there are two exceptions, short life and low value. But there was no such standard in practice on 1st January 2017. Getting me? Okay. Now please calculate the lease liability that should have been reported on 1st January 2017 had the IFRS 16 been in place at that date. 10.58 by Hamza. Anyone else? Lease liability at 1st January 2017 at inception of lease 10.58. Hamza so far. Anyone else? Please tell me the total. Saqib, are you discounting the 3 million? I've solved it here. The treatment as operating lease under IS 17. The rentals should be charged to profit or loss on a straight line basis. Therefore, an annual expense would have been charged. We just calculated how much annual expense would the company be charging? $2.6 million, right? And we have spent 2 years. By the end of second year, yes, Sarita, I'll be sharing this on WhatsApp shortly after the end of session today. How much is prepaid rent? Sure, Saqib. Enough? Yes, Samuel, I'll be sharing this on WhatsApp group if you are there. All right. So we have got prepaid rent and we have charged $2.6 million as an expense. Up to 31st December 2018, Well Limited has charged $2.6 million per year and $5.2 million to profit loss and paid $7 million in total. As of 31st December 2018, there would be a prepaid rent of $1.8 million. This is what we have agreed. For the year 2019, IASB has changed the accounting treatment of leases by issuing new standard IFRS 16 that requires all types of leases except short life and no value, right, to be capitalized as right of use asset with corresponding lease liability. At what amount shall we be recording the lease liability? I had some answers. Hamza, you told me that this should be recorded at, yes, short life means less than 12 months. 10.58, Hamza. Okay, you were correct. Agents, there is no threshold determined by IFRS 16, but industry practice is any asset below $5,000. This is not amount mentioned by IFRS 16, but industry practice is below $5,000 is considered as low value. What do you mean by 1.8, Nelady? Akis, do you remember how do we record lease right of use asset? Right of use asset is equal to what? Lease liability plus down payments plus direct costs plus present value of dismantling. All right, Nelady, you can see how much amount had you prepaid? Rent paid in advance was how much? 3 million, correct. And we were charging this on a straight line basis, correct? So dividing that by 5 years, we are charging how much every year? 0.6 million per year, right? And we have charged this for 2 years. So how much prepaid rent has expired? 1.2 million, right? So balance is out of 3, 1.2 million has been expired and 1.8 million is still in prepaid. Avinash, how do we record right of use asset? Do you remember? Right of use asset is recorded at present value of lease liability plus down payments. So you can see this is present value of lease liability 7.6 plus $3 million that are paid in advance, right? So the right of use asset will be debited by $1.6 million. Lease liability should have been credited by $7.6 million and $3 million the cash has been paid. But this was treatment at 1st January 2017 that should have been if IFRS 16 was in practice by then. But unfortunately, things are not the way these should have been. See forward. What will you do with right of use asset subsequently? What are you supposed to do with right of use asset subsequently? Good. Sakib, on 1st January 2017, there would be nothing expensed out. And Noor says that right of use asset will be carried at cost model now. Very good. Remember, once the IFRS 16 determines the value for right of use asset, after this IAS 16 takes its place, where this would be treated as per IAS 16 now. How much would be depreciation charge per annum? How much depreciation should have been charged every year? The value of right of use is 10.6. And how long is lease term? $2.12 every year. Aisa? Nice. So, see, right of use divided by 5. 2.12 acceptable. The company should have recorded the right of use asset and depreciated it at 2.12 every year. Hassan, we record right of use asset at what? Lease liability plus down payment, that means advance payment, direct costs, and present value of dismantling. Here these two does not apply. So we'll be recording asset at lease liability. How much is lease liability? 7.6. And how much is down payment? 3. right? Understand? Like Hassan, is it clear now? Fair. Okay. Saqib, we should do it retrospectively, but we are getting this to know when on 1st January 2019. See this now. I'm writing and solving. I'll be getting marks for discussing, not just my answers and calculations, right? Lease liability is recorded at present value of probable lease payments discounted at interest rate implicit into the lease, and right of use asset is recorded at lease liability plus direct cost, advance payments, and provision for dismantling if any, right? Subsequently, the right of use asset is depreciated as normal property, plant and equipment under IS 16. Therefore, the annual depreciation of 2.1612. How have I calculated this? I have applied formula on this. Right of use asset I-17 divided by 5 years lease term. You also supported this. Would have been charged every year from 2017 to 2019. But remember, we still have 2019 in our hand, but 2017 and 18 are gone. We are still able to make any corrections in 2019 statements, but we cannot alter 2017 and 2018 statements anymore because these have already been issued. So this error, in fact, this change in accounting policy will be adjusted how? Retrospectively. George, because it is not applicable here. The reason is that the lease term is 5 years and life of asset is 10 years. So that we are using already the minimum of, right? You can see the life of asset is 10 years and lease term is 5 years. So we are already using lower of. Saqib, any defector for 5 years? Let me show you the formula. It's 1 minus 1.1 power minus 5 years divided by I. You can see this. For how long have we entered into the lease? For 5 years, right? Move forward. Now, what has happened? We should have recorded the asset at 10.6 million, right? Charge 2 millions every year, net book value by end of 2017, 18 and 19. We will do it retrospectively. And why not prospectively, Mohib? This change from IAS 17 to IFRS 16 is a change in accounting policy because we are changing the standard, and this change is required by IASB. Getting, Mohib? Since this change is required by the regulatory framework, this cannot be treated as change in accounting estimate. This is a change in accounting policy. Easy, Mohib? Let me know if if confusions are there. Okay. Now the asset should have CRP is capital repayment, Zayan, sorry. CRP is what? Capital repayment. Because the installment is split into two parts. One is finance cost and other is repayment, right? Let me come over there. Dealing with the asset first. So asset should have been recorded at 8.74, 8.47, 6.36 and 4.24. This is past, this is past, and this is still in hand. So the adjustments of 2019 are still possible for me to carry out. But what should have I done in 2017 and 18 was unknown to me because IFRS 16 was not in practice, was not in place. So what I did, I applied IAS 17 that was in practice at that time. Next, how should the liability be treated? The opening balance of liability we calculated was the present value of MLPs, minimum lease payments. Let's amortize this now. I have applied finance cost. Please note the formula, because majority of you are supposed to practice on Excel. So you better try to connect it. Yes, exactly. The question similar to this will not appear in the question because IAS 17 is not part of your syllabus anymore. No, Glory, this is not practicable because IAS 17 is no more part of your syllabus. But this is helpful for me to help you understand how would the change be accounted retrospectively. You have good idea of IFRS 16. So what if I tell you that company has treated the asset as per IAS 17, charging this much amount as an expense every year? You are not supposed to, you are not expected of having deep knowledge of IAS 17, but I can tell you how as per IAS 17 had the company treated the transaction. Yes, Avinash, I'll be sharing this on WhatsApp today. Yes, Nelly, this is a straight line method. Yes, exactly, Glory. You need the technique. We'll work on it. I'll try to spend some time on that as well. But remember, spend 17 or 18 hours sharpening the X. Amina, the exam question similar to this is possible, but will not end up telling you that well company has treated this transaction as per IAS 17, because you have got no idea of IAS 17, but may tell you that as per IAS 17 the rental has been charged on a straight line basis, this much amount has been shown as prepaid rent, and this much amount has been paid and charged to profit or loss. The examiner might tell you entire treatment of IAS 17. Yes, Nalini. It was, if it was RBM. then we'll apply percentage on the net book value. Chesler, we are calculating the CRP as the difference between installment and interest. Let's see the formula. CRP is E29 minus D29 is the difference between installment and finance cost, right? This is the capital repayment. So the liability should have been reported at 6.3, 5 and 3.5. Again, this is past, this is past, this is still in hand, right? We should adjust 2017 and 18 as opening retained earnings. The impacts on 2017 and 2018 financial statements should be charged to retained earnings, because we can no longer control the profit or loss statements for 2017 and 18, right? Let's go through further calculations. This change is required by IFRS and should be accounted for as per the transitional provisions of IFRS 16. We just gone through IAS 8. Yes, Naledi, we can see this, like I'm taking you to this present value calculations. See this. How do we calculate lease liability? Is discounted present value of MLPs, right? Minimum lease payments. And right of use asset is what? Lease liability plus down payment. How much have you paid in advance? 3 million. This is down payment. Got it, Naledi? How have you calculated this 10.6? Easy? All right. So moving forward, since this change is required by IFRS and this should be treated as required by IFRS 16's transitional provisions, noting here, which allow option for retrospective or prospective treatment, telling you very clearly there is option. You can treat this it retrospectively or prospectively. That is allowed by IFRS 16. But as per IAS 8, if this change is reflected retrospectively, impacts on earliest comparative figures and opening equity balances must be shown. So the company has not recorded right of use asset. The company has not recorded lease liability. The company has not depreciated right of use asset. The company has not amortized lease liability. What are we supposed to do? See, for 2017 and 18, how much have you charged as an expense? Yes, that's possible, but this will not serve my purpose. Prius is asking that can we do it prospectively? Yes, but my objective behind this question is to tell you how to account for the change in accounting policy retrospectively. As per IFRS 16, there is an option, but I am not exercising that option because I want to teach you how to deal retrospective changes, right? Fair. How much rent have you recorded in past 2 years? I'm talking about 2017 and 18. Please repeat. How much rent have you charged to expense? 5.2. Good. We could see here we were charging 2.6 every year, and so far till 2017 and 18 we have charged 5.2 million. Very nice. But this expense should not have been recorded as per IFRS 16, right? This expense should not have been recorded because as per IFRS 16, this asset should have been capitalized and the rental should have been treated as amortization of liability. Fair. So in order to correct it, we are supposed to reverse this. We have debited profit or loss, but in order to correct, all we can do is credit retained earnings because we can no longer access the profit and loss statement of past years. Getting? We are supposed to credit this from retained earnings. Plus, had you recorded a right of use asset, depreciation would have been charged. How much annual depreciation did we calculate? It was 2.12 for 2 years, right? Good. $2.12 every year. This depreciation should be charged, but we can no longer access the statement of profit loss of 2017 and 18. So all we can do is we can adjust the opening retained earnings. Next, how much finance cost should have we charged? For 2017, it's 0.76, and for 2018, it's 0.63 million. How much is sum? We should have charged finance cost of 0.76 in 2017's statement of profit or loss and 0.63 finance cost in 2018's statement of profit or loss. But as we can no longer access the statement of profit or loss of 2017 and 18, we are charging this finance cost of 2 years as D29 and D30, right? For 2017 and 2018. Let me show you the sale value. Here is 2017's finance cost plus here is 2019's finance cost. This should have been charged to 2017 and 18 profit or loss, but as I said, we can no longer access their profit or loss. We'll be debiting what? Retained earnings. So the net impact on retained earnings is to debit retained earnings by 0.43. Let me know if there are any confusions, please. Yes, you can. Sam, have you already charged 5.2 as an expense in 2017 and 18? Yes. Should have you charged this if IFRS 16 was in place? No, because IFRS 16 requires that the rental expense should not be debited, but you have already. So when you charge this as an expense, what you did is debit rent expense and credit prepaid rent and credit cash. This is what you have done, but you shouldn't have debited rent. So in order to reverse the expense charged, I am crediting the retained earnings. Daniel, specifically for SBR questions, few questions will ask you to perform calculations and write, explain, and discuss simultaneously. If same requirement is asking you to perform two different things, you can use Excel for that. But for each exhibit, you'll be getting multiple options, word processing and a spreadsheet. So you better solve calculations on a spreadsheet and better type on word processing. Naledi, 0.43 doesn't go to profit or loss. Why? Because we are not able to access 2017 and 2018 anymore. So something that you cannot access is better to alter retained earnings. Yes, Maha, there are possibilities. By some, you cannot be tested for this lengthy question. Of course, if such a question appears in the exam, should be granting at least 30 marks because this is too lengthy. But uh, for the sake of practice, I constructed this question for you. All right, so Naledi, are you clear with this? That this cannot go to profit or loss because we are not able to access the profit loss of 2017 and 18 anymore. So we'll rather be hitting retained earnings. So you can see this. I have debited retained earnings by 0.43. Easy. Maha, we'll be coming towards consolidation tomorrow. And for by the end of the session today, I'll be giving you a question, not to solve it, but to find the solution. Pires, if we applied prospectively, then the remaining number of years would be 3. 2017 and 18 did what they could. So you will be capitalizing the right of use asset from start of 2019 only. Fair. Have you recorded right of use asset? Oh, thanks, Bisong. Moheb, please drop me a WhatsApp message. I'll add you in the WhatsApp group right after this session. But I'll take a dinner break at least. I haven't had my dinner. Okay, so have we recorded right of use machine already? No, because we have been following IAS 17, and as per IAS 17, no right of use asset machine was that was enough for me. True. And that was a very, very big glass. Keeping an eye. Okay. Fair. So by the end of 2018, at what value should the asset be reported? 2018. The asset should have been reported at 6.36, right? Because following IAS 17, you have not recorded the right of use asset. You should now record the right of use asset. Hamza, we simply used to treat rental expenses as an expense. As per IAS 17, no asset was debited, no liability was credited. Only the rentals paid were showed as a rental expense. IFRS 16 says that these rentals are not rentals, but these are installments. So right of use asset should have been recorded, which hadn't been recorded. Let's record the right of use asset now. So at what value should I record the right of use asset? At 2018's net book value. Good. Carrying value by end of 2018. Because 2019 is still in my hands. Fair. If I am solving this by end of 2019, see here, I've altered this. I am doing this for December 2019. So I am keeping it at 2019 year end carrying value. And I must charge the depreciation for the year as well. Okay, now respond me on two things. Are you clear about this? 0.43 impact? Just respond me yes or no. Are you clear about the 0.43 impact? Yes, Hamza. Yes, Hamza. Okay, good. This is the carrying value by end of 2019. Are you clear about this 4.24? And please state your concern. Which area is not clear? Take your time. What aren't you clear about? And okay, so by end of 2019, the machine will be, the right of use asset would be reported at 4.24. All clear? Fair. How much amount should be charged as an expense during 2019? How much amount should be charged as an expense for 2019? Depreciation is how much? 2.12. And finance cost is how much? For third year, finance cost is 0.5. we are supposed to charge 2.6 million as an expense, right? 4.24 is not for the beginning. This is 2019 end, because I have charged the depreciation as well. So are you easy about this calculation of 2.6? This includes depreciation for the year 2.12 and finance cost for the year 0.5. Good. So highlighting this as well. If anyone has any confusion, please, you can feel free to ask. Next, at what value should the lease liability be recorded at end of 2019? At what value would the lease liability be reported at end of 2019? $3.5. Good. So what we normally do is debit finance cost to profit or loss, debit lease liability by the CRP, and credit cash or bank. How much rent are we supposed to pay? Installment 2. So the liability should be reported at 3.5 by the end of 2019. Here we can see in my double entry, I have credited liability by 3.5. So this is also 2019 and CV, carrying value, amortized cost. You have already recorded a prepaid rent, haven't you? Here you can see Soha, yes, EPS is examinable in paper SBR. So diluted EPS is also part of SBR, but fortunately or unfortunately, SBR has never tested EPS. But this is part of our syllabus. Even the consolidated EPS is part of our syllabus. How would you calculate? The group EPS is part of our syllabus, have never been tested. So we believe that is not an important aspect, but you should go through it at least. Fair. So we have a prepaid rent. Very unfortunate, Hamza. If they test it now, if you haven't gone through that EPS, basic EPS, diluted EPS, and comparative EPS and consolidated EPS, this can be a very bad luck. I would suggest you not to leave any stone unturned. Go through it at least. Fair. So prepaid rent of 1.8. Melody, you still have time to go through it, but I still believe this cannot be very important, because IAS 33 EPS is well tested in F7. So SBR examiner has never tested, even in paper P2 and even in SBR. The EPS part has never been tested. Next, so you have already recorded the prepaid rent, but this should not be recorded anymore because we are not following IAS 17 anymore, right? This was recorded as per IAS 17. So I am doing it what? Removing it. Clear? Prepaid rent, I am crediting it by 1.8. Any confusion? If it's clear, simply answer me yes. Because this prepaid rent would be showing in the statement of financial position by the end of 2018 as per IAS 17. But we have capitalized entire $3 million in right of use asset. We have capitalized all $3 million of prepaid rent as a cost of right of use asset. Hamza, we are doing actually what? How are you treating advance payment as per IFRS 16? Hamza, how would you treat advance payment as per IFRS 16? This is good. Added into cost of right of use asset, right? So we have added all $3 million into right of use asset, and these $1.8 million are part of unexpired prepaid, right? So since we have debited that in right of use asset, the prepaid rent should no more be shown as prepaid. Hence we are crediting it and removing it. Finally, the only payment of 2019 $2 million rent. Are being credited from cash or bank. So you can see our entry is balanced. In fact, it's plus minus, my mistake, not a sum. So debit plus debit plus debit minus credit minus credit minus credit. So debits are equal to the credits. Fair. So winding it up for today, I am giving you another question. This one. I have adopted this question from the CPD box, IFRS box. The company has fully depreciated machine still in use. What do you suggest? If a company is still using a machine that has been fully depreciated, how do you think should it be recorded now? Any suggestions? If a company is still using a machine that has been fully depreciated, how should that machine be reported in profit loss now? Very nice. Hamza, how would you apply it prospectively now? It is all depreciated. Saqib, a good idea. Apply revaluation model. Change in estimate, but this would be prospectively Sarmad. Machine is already fully depreciated. So you will be showing machine at zero value, but you are still using it. Saqib, you have got no carrying value. What use will give the value in use? It should be revalued. Makes sense. It is a change in accounting estimate. Good. There will be no further depreciation, right? Hassan says this should be applied prospectively. Hassan, you thought the machine has useful life of 5 years, and now you are telling me the machine has life of 8 years. Changing the life or estimating the life of machine Is that a change in accounting policy? Maha, if the machine has nil residual value and it is fully depreciated now, there is zero net book value of machine now, but you're still using it. How come, Mohib? At what value will you be treating it as a new asset? You acquired machine 5 years back. After 5 years, the value of the machine in your balance sheet is zero. Glory, a good idea. There should be a revaluation now. Remember one thing. What does IAS 17 asks the preparator to do? Remember, a good idea, Hamza and Akis. Moheb, good idea. Revaluing the machine can do the trick, but IAS 16 requires that estimated useful life of machine, estimated residual value of the machine, and pattern of economic benefits must be assessed at least at balance sheet at each reporting date. Is that so? IAS 16 requires entity to assess at least at each reporting date three things. What? Useful life, residual value, and pattern. If the company did not timely detect the revision in useful life of the machine, which was although required by IAS 16, if the management failed to follow IAS 16's requirements, that is an error. If IAS 16 has required you to assess at least at each balance sheet date the life, the residual value, and pattern, and you fail to do so, failure to apply financial reporting standard is an error. And because this error is a material error, if you should correct this retrospectively. Fair? So we have got two possible solutions. One, to revalue it and depreciate over the remaining useful life. Option number two, correct this error retrospectively. Akis, the IAS 16 required the company to assess at least at each balance sheet date, but the company failed to do so. And company did not reassess the life of the machine timely. Now, after 5 years, it's telling me that the machine is fully depreciated, but it can be operational for further 2 to 3 years. And pattern of benefit same. Useful life, residual value, and pattern of consumption of benefits. That is the depreciation method. No, you're not supposed to disclose it probably, but you are supposed to make a correction retrospectively. Fair. Has the question in the PowerPoint? You guys have the PowerPoint. Show me an Excel working. It's your homework for tomorrow. Show me how this error would be corrected. The topic of this could be machine at zero net book value is still in use. Hassan, the information was available at that time. Information was available at that time, but company failed to assess it. Naledi, from me, 20 marks for this. Okay. So signing off for today. It's already quite late. Fair. Here's your practice question. Please try to attempt it, and we'll be meeting hopefully tomorrow. Fair. Thank you so much. We'll be discussing on WhatsApp group any confusions you have. Of course, Hassan, I'm just immediately sharing this on WhatsApp group. So those who are not on WhatsApp group, I would request you to join immediately. Dhwani, we'll be switching towards consolidation tomorrow, and very important area, 30 plus 20 or total 50 mark section, at least 30 marks, right? So we'll be solving consolidation tomorrow. Thank you so much for your feedback. Sam, thanks a lot. Naledi, I'll be sending the answer on WhatsApp. Have you joined the group? Or you're securing your privacy and using Telegram? Okay, nice. So you can drop me a message on Telegram. I can share over there as well. But if you are on WhatsApp, you can drop me a message over there or join the group. Otherwise, you can share your email. I can email you as well. But private dealing can be very difficult for me to manage. So a general forum would be very helpful. Fair. So thank you so much, everyone. We'll hopefully be meeting tomorrow. Stay healthy, stay safe, and do practice. Good luck. Someone has dropped email here, but I am unable to copy it. Cat Laga, I'm not able to copy your email from here, unfortunately. So is it possible if you could drop your email on WhatsApp? Okay, you have got trouble. Fair enough. I'm sending you. I'm sending you immediately. Bye bye. Goodbye. Thank you. Good night, Savina. Thank you. Take good care. Take good care. Bye bye.